So let's talk about filing status. We've got 5 filing statuses. And filing status, as you can see, one of the things that is dependent on filing status is that standard deduction amount, right? So if you're single, if you have a single filing status, you're going to get in 2024, and this changes every year, but in 2024, you're going to get a standard deduction of $14,600. If you're married filing jointly, if that's your filing status, you get what, $29,200. Essentially double for married filing jointly. If you're head of household, it's halfway in between the two. But we have 5 filing statuses: single, married filing jointly, married filing separately, head of household, qualifying widow or widower with a dependent child. So how do we define it? It would seem that it would be easy, right? If you're single, you're single. For the most part, it is easy, but there are some, I'm going to tell you the answer to every tax question is it depends. Okay, so it kind of depends on each individual situation. So single, if you are single, it means that you are unmarried as of the last day of the year. December 31st, you are unmarried. You may have started out the year married, but if you're ending the year unmarried, then you are single. So if you got divorced on December 30th, but you were married the entire year, well, December 31st, you're divorced. So you are single. So whatever your status is on the last day of the year determines what your filing status is, with one exception. So single, you're unmarried at the end of the year, except for if you are a widow or a widower with a dependent child, which has its own filing status. So that's one of the exceptions there. Married filing jointly. This means you're married as of the last day of the year. If you get married on December 31st, you are considered to be married for the entire year. Your filing status is married for the entire year, not just on December 31st. There are people that will schedule their marriages and divorces simply based on tax code, what's most advantageous or what's a disadvantage. They won't do what's a disadvantage tax-wise. So for married filing jointly, what you're doing is you're combining all your income. You saw that in several of your homework problems. Married couple, both of them had W-2s. We add it all together, right? It means that we also add all of the deductions together. So everything gets combined. All income gets combined, all deductions get combined. Again, if you are married as of December 31st, you're married as though you were married for the entire year. Now, a person who is legally separated from their spouse, this is where kind of some of those nuances come into play. Under a decree of divorce or separate maintenance agreement is not considered married. So you could still technically be married, but if you have a separate maintenance agreement, you're separated and there's a maintenance agreement, and all of it is, it's not just an agreement between the two parties, it was all done in court, then you would not be considered married as of the end of the year. Couples in the process of obtaining a divorce that's not yet final are still considered married though. So if your divorce doesn't finalize until January 15th, December 31st, you're still considered to be married. Some differences: if you're a non-resident alien at any time during the year, generally speaking, you can't file a joint return. So if one of the spouses is a non-resident alien. All right, so most married individuals will file jointly. It's usually the most tax advantageous filing status if you're married. However, sometimes you don't want to file a tax return with your spouse. Maybe you don't trust your spouse. Maybe you're in the process of getting a divorce and you're not speaking with each other. There could be any number of, maybe it's a second marriage and You've all got your assets separate, and so you just want to file your taxes separately. There's another filing status for married individuals. Still depends on whether you're married as of the end of the year, December 31st, but that status is married filing separately. So in that case, if you're married filing separately, you're going to file 2 separate returns. So when you have a tax return, you have to sign it. Each individual has to sign it. If you're married filing jointly, both spouses have to sign that tax return, and you're signing it under penalty of perjury, meaning you understand all the information that's on that tax return and you agree with it, and you think that it's complete to the best of your knowledge. Now, if you have a spouse that's not very trustworthy, or you're not quite sure if they're actually reporting everything, if you're signing a tax return with them, you might decide you don't want to do that. That would be one instance where you might decide, okay, we're not going to file jointly. We're going to file separately, because then I'll sign my tax return, you sign your tax return. We're still married. That's all right. But we're going to file 2 separate tax returns. That would be married filing separately. Usually it's not a very tax advantageous filing status, though. Usually, a lot of times it's going to cost you more in taxes. So clients might want to do a cost-benefit analysis of what the best filing status is. If one of the spouses, so if you're married filing separately and one of the spouses itemizes their deductions, the other spouse has to itemize deductions as well. You cannot have one spouse taking itemized deductions and the other one taking the standard deduction, because the IRS doesn't want you essentially getting an additional tax advantage. Because if you think about it, if your itemized deductions were $30,000, but the standard deduction for married filing separately is $14,600, otherwise one spouse could take all the $30,000, the other spouse would take $14,600 and get $44,600 in deductions. Whereas if they were married filing jointly, they'd only be entitled to the $30,000. So you can only, if one taxpayer itemizes, the other one also has to itemize under married filing separately. Head of household. So in order to qualify as head of household, you have to be unmarried at the end of the tax year. You have to be a U.S. citizen or resident for the entire year. You cannot be a qualifying widow or widower, and you have to maintain a household that is the principal place of abode for a qualifying person for more than half of the year. This is the most complicated filing status to figure out. There are a lot of nuances to it. So principal place of abode of a qualifying person. So we have to figure out what a qualifying person is for more than half of the year. Temporary absences, such as for attending school, do not disqualify the person under this section. So that means that like a single parent who has a college-age child who is still considered a dependent, that the kid's away at college, that temporary absence, they would still be considered to be, the home would still be considered to be their primary place of abode. Okay, so that temporary absence is not, doesn't count. So taxpayer has to pay for more than half of the cost of keeping up a home for the entire year. This would, and they include what the cost would be and what is not included under the cost of keeping up a home. So a taxpayer's parents, there's a special rule allows a taxpayer's parents to live in a household separate from that of the taxpayer and still permits the taxpayer to qualify for head of household status. Taxpayer, however, must pay for more than half the cost of the household where the parents live. So you could technically have, like if you have elderly parents who need assistance, they could technically be considered part of your household. If they are a qualifying person, then they could be considered, you could be considered for head of household status. Let's see. So this chart may be helpful. Who is a qualifying person who is a qualifying person qualifying you to file as head of household? So if the person is your child, son, daughter, grandchild, who lived with you for more than half of the year, and the child is single, and the child is single, then they are considered a qualifying person. If the child is married and you can claim the child as a dependent, they're a qualifying person. If the child is married, you can't claim them as a dependent, they're not a qualifying person. So I'm not going to go through this all in detail, but this may be helpful to you when helping to determine whether somebody is a qualifying person for head of household status. And then we have the last one, qualifying widow or widower with a dependent child. Now, with a dependent child is important here. Not just a widow or a widower. You have to have a qualifying child as a dependent. So if a spouse dies during the year, the surviving spouse will file a joint return in that last year. This is the one exception to the last day of the year rule. So, for example, if the taxpayer, there's married couple, and one of the spouses dies January 10th of the year. That whole year, they're considered married the whole year. So this is the only exception to that last day of the year. So they would still be considered married, and they would file as married filing jointly in the year of death. The next year, however, if there's a dependent child, so, the husband dies, the wife has a dependent child who's, 16 years old, in the following year, as long as that taxpayer does not remarry, they would be able to file as a qualifying widower with a dependent child. What that does is that gives them the same standard deduction as a married couple, as married filing jointly. So they keep that status. They're allowed to have that status for 2 years. Okay, so unless they remarry, if they remarry though, they're going to file as married filing jointly, most likely. So they get this if they were eligible to file a joint year in the year that the spouse dies. The taxpayer does not remarry before the end of the year. Again, if they remarry, they're going to file as married filing jointly with their new spouse. The taxpayer paid more than half of the cost of keeping up a household more than half the cost of keeping up a household, and the household was the principal place of abode for the entire year of both the taxpayer and child, stepchild, or adopted child. So essentially what this does is for